It's a great pleasure to be with you. And I have a similar message to Goran. So I would recommend that those who were present throughout his talk could slip off and have an early gin and tonic. And those who had a protracted tea could stick around and hear very much the same from me that you would have heard from Goran if you'd been there. Patience, patience, patience is the title I've chosen. This was a mantra of Peter Cundall, who Thomas mentioned earlier. Peter, as some of you will know, was a renowned value investor with a glittering record. And I knew him quite well. He died in 2011. And to be a value investor, his message was that you have to be long-term, you have to be patient. And patience is a neat word because it not only means being prepared to wait, but its Latin root means being prepared to suffer. And you have to suffer a lot sometimes if you're a value investor. Peter himself put it this way. He said that he might miss a lot of jokes on the way, but he would have the last laugh, and he did. And so my message, like Goran's, is that the conditions for value investing to do well over the next decade have hardly ever been stronger. And I'm using value investing in its narrow definition. I'm returning to basics in this. I handed over portfolio management to my firm 5 years ago, and so I have the privilege, if you can call it that, of being a little bit distant and having a bit of perspective, which maybe makes me more objective about these overarching themes, maybe not. And others, of course, have a much wider definition of value investing. And what I mean by a narrow definition is that this is about investing in companies which have low valuations in terms of price earnings ratios, price cash flow ratios, price to book value, high dividend yields. I'm not using the wider definition, for instance, that a share price which is at a discount to intrinsic value calculated by discounting cash flows into the quite distant future can be regarded as a value investment. I think that can be used as a description of practically any form of investment style. And I'm not making a judgment as to whether one way of doing things is good and the other way is bad. I'm simply talking about what we as a firm do, what is in my blood to do. And because it's in my blood, it's that which fascinates me now. So to be clear, I'm looking at what George, you talked about earlier, as naive value. And this merely is to set some boundaries around the place in which active investors then look. It doesn't mean that you buy the naive index of value. That's one way of doing things, but most active investors would, as George talked about earlier, be looking for shares which are in that section of the share universe. So I'm shamelessly going to show you some charts which are some of them repetitions of those you've seen earlier from both Francisco and from Goran. So this first chart shows a data series which is provided by a firm appropriately called 2 Centuries. And 2 Centuries discovered analysis done by Gertzman covering the period 1825 to 1871, by Cowles covering the period 1871 to 27, and by Farmer and French, the Nobel Prize winners, covering the period 1927 to 2020. I'm amazed that they found value shares in 1825. I didn't know such things existed, but apparently they did. And what they found was that between 1825 and 1871, value outperformed growth by 3.7% per annum. In the second period, 3.9% per annum. And in the third period, 2.7% per annum. So the long-term advantage of value has been pretty clear in history. Now, of course, there's only one history, and the future may be very different from the single very long period of remarkable consistency. And why does it work? I think it works, as people like Seth Klarman say, because it is emotionally difficult to do. It means that you're frequently buying things with which something has gone wrong, and that is emotionally tough. It means you can't have a short-term outlook because very often the thing that has gone wrong doesn't cure itself in a hurry. And I'll show you in a moment or two what the medium-term returns of this approach are. So it's because it's emotionally difficult that not everybody does it, even though the track record of value in relation to growth is so strong. There are periods in which it doesn't work at all, and we've just had the longest such period in history, at least according to 2 centuries, and I don't think anybody is going to improve on their in going back any further than 1825. The second chart on this page shows the maximum drawdown. That's to say the maximum outperformance of growth compared with value during the periods in which that outperformance has taken place. And so in 1841, the drawdown was 50%, value underperformed by 50%. In 1862, by 49%. In 1904, by 59%. In 1932, by 54%. And now, up to November 2020, when there's been so far a mild reversal, 59%. So these figures are almost nerdishly precise, but the drawdown has never been greater than it has been in recent years. And so the elastic has got ever more stretched. And that suggests to me, it suggests to us that we're due for a snapback. The elastic cannot stretch forever. You never quite know when that point of maximum stretch has been reached, but at some point, and it may be indicated by these figures that it's not far off, it snaps back. And the result, of course, is that growth has become ever more expensive. And we just saw Goran show something which had the same message, but I'll just summarize this very quickly. There's a footnote which you may or may not be able to read. And what it says is that this shows the market cap weighted inverted trailing earnings yield, which I think is a rather elaborate way of saying it shows a price earnings ratio. And it shows the price earnings ratio for value, which is at the bottom, and for growth at the top. And the point about this, and it's the most expensive quintile and the cheapest quintile is the measurement in each case. The point about this is that if you draw a trend line through that upper line, which is the growth end of the market, what you see is a trend line which seems to work, a straight line, until you get to about 2015, when growth simply takes off and it's departed off the charts. It's maybe not surprising that the expensive gets more expensive over time because of technological improvements and all sorts of other things. But to depart from the trend entirely is pretty remarkable. The bottom line stays pretty much within a fairly constant, narrow range. And it's now a slight cause for caution. It is pretty much at the top end of that range, but nonetheless, it is a constant and narrow range. And so we are very committed, I am very committed to the virtues of value, which I think has a bright future. It's not different this time. There are excesses typically because the enthusiasms in markets become excessive, the glooms in markets become excessive, and we've had perhaps too much gloom in the value end of the market and too much enthusiasm in the growth end of the market. And this chart shows the same thing, but over a shorter period and as applied to the world indices. And Goran has already made these points, and so I'm not going to labor them. What they show is that a lot of the increase in the rating of a lot of the performance of the growth index over the last several years has been as a result of some fairly rampant re-rating, not due to growth in earnings, but to an increase in multiple. And why do these things matter? Well, I think most of us in this conference are fairly old-fashioned about it. We do think that valuations matter. We don't think that simply measuring eyeballs or clicks or socially adjusted earnings is an appropriate method of valuation. We believe in tried and tested methods of valuation. And this is why, this is the chart that every value investor needs to have under his or her pillow. And when you wake up at 3 o'clock in the morning and you need reassurance, turn on the light and look at this, because what it shows is on the x-axis are the Graham and Dodd price earnings ratios. over a whole series of time since 1880, Graham and Dodd price earnings ratios being essentially the same as Shiller PEs. That's to say, today's price divided by the average of the last 10 years' earnings. So that's the x-axis. On the y-axis is the return that you get from investing over the next 10 years. And there is a very simple relationship and a very simple conclusion. And that is that if you invest in shares which have low Shiller PEs or Graham and Dodd PEs, 5 to 10, then you get a high return. And if you invest in shares which have a high Shiller PE, you get a low return over the next 10 years. But as I said, why is it not so straightforward that everybody should try to do it? Because you do need quite a lengthy period. These are 10-year returns. The returns over 2 or 3 years would be very, very different, probably random. You see here, there is a nice progression from left to right. There is a direct relationship with each stage of increase in expensiveness of shares. But if you were to look at 2 or 3 years, you would get something pretty random. And most people have a short-term outlook. In my time in investing, I would say that one of the greatest inefficiencies in markets has been the increased short-termism of most of the participants. And that provides a great opportunity for those who are not short-term. So this is, of course, not the only way of investing. If one could forecast accurately, then that would be great. If you can forecast the rate of growth 5 years out, 10 years out, then that's wonderful. And that's the key to many people's success. There are many people who have done so successfully. There are many, many more who have not done so successfully because forecasting is extremely difficult. You remember Thomas Watson of IBM in 1943 said that he thought there was demand for maybe 5 computers in the world. Marshall Foch in 1911 said that he thought that aeroplanes were very interesting inventions, but they had no military value. And H.M. Warner in 1927 said, "Who the hell wants to go to a film in which people talk?" So forecasting is very difficult, and that makes an approach which minimizes forecasting and maximizes what Goran has just referred to as fact rather than fiction. That makes that approach much more attractive, at least to me. You had some examples from Goran of the expensiveness of various areas. If you look at the extremes at the other end of markets from the value end about which I've been talking, this chart shows the enterprise value to next 12 months revenue multiples. He talked about the proportion of shares in the States, which are selling at more than 10 times revenues. These are selling at 61. The top 5 median is 61.5 times sales, and the median for the market as a whole of software companies, is 21 times sales. You need an awful lot of earnings in the future to justify that. And I would just remind you of what Scott McNealy, who was the chairman of Sun Microsystems, said in 2002, so 2 years after the crash. He said, 2 years ago, we were selling at 10 times revenues when we had a share price of $64. At 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I have 0 cost of goods sold, which is very hard for a computer company. That assumes 0 expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? That was Scott McNealy in 2002. And where is Sun Microsystems now? This is another quite interesting index, compiled quite sort of non-ironically by Goldman Sachs, and no doubt something that people invest in very energetically, and as you see, will have made a colossal amount of money from. And it's an index of the non-profitable technology companies, non-profitable US-listed companies in innovative industries. And, well, obviously, you look at that, we need to get in there quick. It's gone up 4 times since 2020. And then this, more mundanely, is the Schiller P for the S&P 500. When I started in 1981, the Schiller P, I think you can see here, I don't know if, does my cursor work on your screen? I think it does. So 1981, the Schiller P was way down here at 7 times, and it has now shot up to this level here. In 1981, America was pretty much down on its luck. Interest rates were 14, 15%. Inflation was 14 or 15%. The President Carter was president. The hostages were taken in the Tehran embassy. The helicopters crashed in the desert trying to get them out. America's self-esteem was about as low as you can imagine. And that was a wonderful time to start. Where are we now? In business, and I would say in government, there is a tremendous amount of hubris in America. There is a tremendous pride, justified, that they've been quickest in doing everything, both at a governmental level and at a central bank level, and also at a business level. Quickest recovery from disasters, quickest recovery from the 2008 to 9 financial crisis, from the 2001 World Trade Center attack, and so on. So there is tremendous pride, and that is reflected in the Schiller P. There's a paradox, which is that Pew Research, which is a well-known research organization, finds that 90% of Americans are dissatisfied, 17% are proud of their country, and 71% are angry. So there is a sort of dissonance between the business community and the government community and people at large. And I think that makes for a dangerous mixture because there is something slightly unreal about it. Now, that's the US. This chart shows the expensiveness of the American market compared with non-American markets. The bottom line in this chart on the right-hand side is the EFI index, the non-US index. The middle line is the US index, and the top line is one over the other. So the US has never in this period since 1979 been more expensive in terms of Schiller P relative to non-US markets. And so something is not quite right. And this is not a habitual relationship. If you look back, in 1996 to 2005, the Schiller Ps were pretty much the same. Before 1996, the US market was less expensive than international markets on this basis. And since between 2005 2008, the ratios have simply parted company, and the US has become as strikingly expensive as the non-US markets were in 85 to 89. 89 was the year in which the Nikkei touched 40,000, the level which it's never reached since. So I think that I feel overwhelmingly strongly that this relationship can't continue forever. Heaven knows when it changes. Nobody can call these things exactly. But it seems overwhelmingly likely that non-US markets will outperform the US market over the next 10 years or so. And that is principally because of their valuation. This is a well-known, rather hackneyed chart. It's supposed to be the one that Warren Buffett likes to look at. Whether he does or not, I don't know. But it shows that the market cap to GDP of the States is very, very high. And this is to reiterate a theme already touched on. The most expensive 5 stocks in the US are at I think a record level of percentage of the market cap of the S&P as a whole. Now you see that we in Oldfield Partners drew a nice red circle here when we thought we reached the peak. And of course we hadn't. It goes on. We can't predict when. We can only say that we are at a level at which we're due for a change. So there is a temptation to extrapolate, to assume it goes on, and to assume that the supremacy of tech, the supremacy of the states has been for very good reason, will continue. And there are new ways of making things, there are new ways of doing things, there are new ways of providing services which deserve high valuations. And all this, of course, has accelerated during lockdown, in which the percentage of online retail sales went to 36% from 20% before. Netflix was adding 16 million subscribers a quarter until the last quarter or so. And there were hundreds of millions of Zoom meetings compared with the fewer than 10 million that there were in 2019. And on the other side of the economy, in the old economy, you have rents under pressure, you have department stores being vacated and turning into residential, and the whole parts of many industries being turned upside down. And so we're in an atmosphere, we're at a time when the atmosphere is rather similar to that in 2000, when there were people who said, you just don't get it, to the old lags who still depended on value. I think that parallel is fully justified because what is so striking is that technological achievements are quite remarkable, but markets run ahead of them. And so in 2000, I remember having meetings in which people talked about Nokia selling 1 billion telephones a year, and that seemed absolutely extraordinary. But in fact, they did go on to sell 1 billion telephones a year. It didn't stop the valuation of Nokia coming down very sharply from 2000 because markets had simply gone too far. And my final graph is one which is really at the root of the problem. Since 1982, we've had really nothing but declining interest rates. This is the 10-year US government bond yield. Dr. Doom, Henry Kaufman, said in August of 1982, or might have been July, that the bond market had bottomed. And so it had. And it really hasn't looked back very much. And we now have these record levels with an acceleration of the fall in the last year or so. George, you wrote just very recently, I quote, given traditional relationships, when inflation is 5%, 10-year US Treasury bond yields should be around 7%. They may not be going there anytime very soon, but this is not a natural relationship to inflation. Hold on one second. Telephone. They may not be getting there soon, but they will get there. They will get to a more natural relationship at some point. And so the conditions in which bond yields are likely to be rising over the next 10 to 15 years are not conditions which are good for sections of markets that rely on very low discount rates. And that means that I think we may well be, to use George's words at the beginning of this session when you were asking the question rather than giving the answer, we may well be at the threshold of a golden period for value investing. It's dangerous to forecast, and I will finish with a little anecdote about forecasting. Kenneth Arrow was the Nobel Prize-winning economist who, in the Second World War, was a meteorologist employed by the American Air Force. And he was asked to make medium-term weather forecasts. And he quickly realized that these were no better than random. So he asked to be relieved of this responsibility. The answer came back, the commanding general is well aware that your forecasts are no good. They are essential for planning purposes. And so I think that's the status of forecasts. We can't exactly forecast, but we can identify conditions which are likely to lead to one thing or another. And I think this is a time when the foot should be on the accelerator with value and the foot should be on the brake with growth stocks.